All right, let's dive in. Welcome to the deep dive. Today we're tackling real estate investing, and we're using Real Estate Investing for Dummies as our trusty guide. So if you're ready to unlock the secrets of successful property ventures, buckle up and get ready for some serious knowledge.
That sounds good to me.
So why is real estate such a hot ticket in the investment world?
Well, I think, you can boil it down to a couple of key things that
Yep.
the authors highlight really well. It's the potential for cash flow,
Mm-hmm.
that sweet, sweet rental income coming in every month.
Yeah.
And then there's the possibility of appreciation,
Yeah.
your property going up in value over time.
Yeah, I get it. It's like that double whammy of returns, kind of like owning a business or
Yeah.
dabbling in the stock market. But, with real estate, it feels way more tangible, way more, solid. It's like you're building wealth through something you can actually see and touch.
Yeah, absolutely. There's that sense of ownership that you just don't get with other investments. But let's not get ahead of ourselves, okay? It's crucial to remember that those returns,
Mm.
they're not like etched in stone or anything.
You're saying it's not a guaranteed money printing machine.
Exactly.
Yeah.
Just like any other investment out there, real estate's going to have its ups and downs. You can't go into it thinking you'll be swimming in cash every single year. That's setting yourself up for a big disappointment, maybe even a financial wipeout.
Right. The Dummies folks make that super clear. They're all about that long game. They're talking holding on to properties for like 7 to 10 years, even longer.
Yep. It's a marathon, not a sprint. That's their motto.
Makes sense. So before we go property hunting, let's talk about the prep work. What do they say about getting our financial ducks in a row?
Oh, they're big on this. It's
Yeah.
all about getting your financial house in order before you even think about dipping your toes into real estate.
So, like, no massive credit card debt while trying to get a mortgage.
Exactly. Pay down that high interest debt, like yesterday. Make sure you've got a healthy emergency fund and a nice stable income to cover your expenses.
Got it. Solid foundation first. Now, what about those dreamy vacation homes? Smart investment or just a lifestyle splurge?
Ugh, vacation homes. The authors get real about these. They point out that those beautiful escapes are often more about, pampering yourself
Yeah.
than making a profit.
Yeah, it's easy to get swept up in that fantasy of owning a beach house, and then reality bites.
Right. It's easy to let emotions drive those decisions.
Okay, so we've got those vacation homes. They might not be the best investment, but let's move on to the broader world of investment properties. What types are out there?
Well, you've got those classic single-family homes, the ones you see in those idyllic neighborhoods. But the authors point out that, especially nowadays, they could be pretty tough to make profitable early on.
Really?
Oh, yeah. Especially when those purchase prices are sky high, and you might find that rent just doesn't quite cover all your expenses.
Plus, isn't there that risk of having just one tenant? What if they suddenly decide to skip town?
Exactly. You're left carrying the whole burden.
So what's a better option?
Well, the Dummies experts, they suggest considering attached housing, like duplexes, townhomes, that kind of thing. They're generally more affordable, and you're splitting those maintenance responsibilities,
Hmm.
which can be a huge plus.
Yeah, no more solo lawn mowing or roof repairs. Okay, attached housing, check. Now what about condos?
Oh, yeah. Condos are super popular, especially for, first-time investors.
Hmm?
But the authors throw out some yellow flags here, especially when it comes to those converted apartments.
What do you mean?
You gotta be careful. A fresh coat of paint and some fancy staging might look tempting, but underneath all that, you could be dealing with old systems that are about to give up the ghost. Thorough inspections are a must.
So, like, don't be fooled by a shiny new paint job when the engine's about to fall out.
Exactly. Don't let those superficial upgrades blind you to the potential deal breakers.
Got it. Superficial upgrades, no good.
Yeah.
So, moving on to commercial real estate.
Commercial real estate now, that's a whole different ball game.
Right. And the authors really emphasize, really stress the importance of analyzing supply and demand, vacancy rates, all those rental trends.
Yep. It's a different beast, for sure. And they bring up this term negative absorption, which basically means there's just way more available space than there are businesses wanting to rent it.
So, kind of like trying to sell ice to Eskimos.
Exactly.
Major red flag.
Yeah.
Got it. Okay, so what about land?
Land. The authors dive into all the zoning stuff, environmental limitations, access rights. They even warn about those landlocked properties where getting easements can be a nightmare.
Like a real estate horror story.
Pretty much.
You're stuck. Okay, so we've covered different types of properties, but the authors also go into how to acquire them, like foreclosures, short sales, all those things. So what opportunities do those present?
Well, with foreclosures, they highlight how you can potentially snag a bargain, especially during that pre-foreclosure stage when sellers are often, pretty eager to make a deal.
But it's got to be like a super complicated process, right?
It can be. You got to be comfortable with the risks, both legal and financial.
And what about short sales? Those are where the seller owes more on the mortgage than the property's worth, right?
Exactly. And the authors point out that those can be super lengthy and unpredictable. They might not be the best fit for, like, individual investors who just want one property.
Makes sense. Now, lease options sound intriguing. You lease with the option to buy it later. Seems like a way to get your foot in the door without that huge down payment.
That's the gist of it. You're essentially controlling the property, and you've got the right to buy it at a set price within a specific time frame.
But isn't there the risk that the price will be, like, way off by then?
That's why negotiating a favorable option price is crucial. You want to make sure it reflects the potential future value.
So you're locking in a price that makes sense for your investment strategy.
You got it.
Okay, so we've got foreclosures, short sales, lease options. Now let's move on to something that might be a little less familiar, REITs. Can you give us a quick breakdown of what those are?
REITs, or real estate investment trusts, are companies that own, operate, or finance those big income-producing properties, like apartments, shopping centers, those kinds of things.
So like instead of buying a whole building, I'm buying stock in a company that owns it.
Exactly. And the authors suggest comparing returns and expense ratios just like you would
Yeah.
with any other stock or mutual fund.
That's a great way to think about it. Now, what about TICs? I've heard that term thrown around, but I'm not really sure what they are.
TICs, or tenancy in common investments, are where multiple investors own a slice of a property together.
So it's like group real estate investing.
You got it. And it can be pretty appealing because you get professional management and potential tax benefit.
Oh, those tax benefits always sound nice.
But the authors warn about the high costs involved, especially when you're using something called a 1031 exchange to defer taxes.
Okay, 1031 exchanges, we'll have to unpack those another time. What about trust deeds and tax lien certificates?
Oh, trust deeds. Those are essentially investments in real estate debt. You're kind of like the bank. You buy a trust deed, which is secured by real estate, and you receive interest payments.
So it's kind of like being a lender.
Exactly. But there's that risk of late payments or default.
Right, no investment is without risk. What about those tax lien certificates?
Those are interesting. They let you profit from, those delinquent property taxes that some folks just don't get around to paying.
So like a way to make money from other people's procrastination.
Pretty much. You're buying the right to collect those unpaid taxes, often with a nice interest rate.
Sounds like a good deal.
It can be. But the authors emphasize the importance of understanding those redemption rates.
Redemption rates.
It's basically like the chance that the property owner will actually pay up. And if they don't, well, you could end up owning the property.
Wow. That's unexpected bonus. Okay, so we've got all these investment options swirling around, but the authors really, really stress the importance of putting together a real estate dream team.
Absolutely. It's not just about having a bunch of fancy titles, right? It's about finding professionals you trust, people who've got the experience and the know-how to guide you through this whole complex world of real estate investing.
So who are the key players on this dream team?
Well, you've got your lenders or mortgage brokers. Then there are those real estate agents, of course, appraisers, attorneys, tax advisors.
That sounds like a full house.
It can be, but having them in place before you start seriously property hunting, that's key.
Why is that so important?
Because it means you can move quickly and confidently when that perfect opportunity comes knocking.
Makes sense. So about finding those properties, the authors suggest thinking beyond those perfectly staged, move-in ready homes. They seem to be like big fans of those diamonds in the rough.
Absolutely. Those fixer-uppers, the ones that need a little TLC,
Yeah.
they can offer some amazing opportunities.
One strategy that caught my eye was house hacking. Can you explain that one?
House hacking is like the ultimate way to dip your toes into real estate investing without, going all in.
So how does it work?
You buy a multi-unit property, live in one of those units yourself, and then rent out the others.
Ah, I get it. So you're basically living for free and getting some landlord experience at the same time.
Exactly. Plus, you might even generate some positive cash flow from day one.
Sounds like a win-win. But I'm guessing there are some tax implications to consider.
Always. Financing and ownership structure, they all come with their own tax consequences,
Mm-hmm.
especially when you're talking about deducting that mortgage interest and depreciation.
So best to have that tax advisor on speed dial.
Absolutely.
Okay, house hacking. Check. Now, let's talk about financing. What are some of the options the authors cover?
Well, they run the gamut, from traditional mortgages to more uh, creative solutions like seller financing.
Seller financing sounds interesting. Can you explain that one?
It's a situation where the seller, instead of going through a traditional lender, actually helps finance the purchase themselves.
So the seller's kind of like the bank?
Exactly. And it can be beneficial when traditional lending options are, you know, a bit limited.
I see. But let's not forget those traditional mortgages. We've got fixed rate mortgages where your interest rate stays the same for the entire life of the loan. And then there are those adjustable rate mortgages or ARMs. Those can be tempting with those low initial rates. But
Ah, yes, those ARMs. They can be a bit of a gamble, especially those negative amortization ARMs, where your loan balance can actually increase, even if you're making those monthly payments.
yeah, those sound a bit scary. And speaking of things that can sneak up on you,
Yeah.
loan fees, those are all those pesky fees that come with getting a mortgage.
Oh, yeah, those fees. Origination fees, appraisal fees, closing costs, they can add up fast.
Okay, so bottom line, read the fine print. Now, onto that all-important factor, location, location, location.
The mantra of real estate.
Right. It's like the first rule.
Yes.
So what specific location-related stuff do they highlight?
Well, they dive into demographics,
Yeah.
population growth, income levels, the presence of families.
Okay.
And then there are the economic factors. Job growth, diversity of industries, major employers. Basically, you're looking for areas where people are moving to, not moving away from.
So it's like checking the pulse of a community, making sure it's got that vibrancy.
Exactly.
What else?
Well, they warn about those barriers to entry.
Mhm.
Things like zoning restrictions, environmental regulations.
Even just plain community pushback against development.
So basically roadblocks that could make it tough to find or develop properties.
Pretty much.
Got it. Now, one concept that really stuck with me was the path of progress.
Ah, yes, the path of progress. The authors use a great example in the book about a medical center complex built in a suburb of San Diego.
Oh, yeah, I remember that.
It was pretty much a blank slate before that medical center came along, but then, boom, it attracted all these businesses, residents, investment, and the whole neighborhood
Yeah.
transformed.
So it's about spotting those areas that are on the verge of like a major upswing.
Okay, so demographics, economic factors, barriers to entry, path of progress. Got it. And of course, supply and demand. That's always key.
Always. The authors suggest looking at vacancy rates, rental trends, the balance between, rentals and homes for sale. They even say to look at things like building permits and absorption rates.
An absorption rate.
Yeah, it's basically how quickly those new properties are being snapped up.
So it's all about gathering all the clues to see if an area is headed for a boom or a bust.
You got it.
Now, no matter how promising a location seems, there's one step you absolutely cannot skip: due diligence.
Amen to that. Due diligence is your insurance policy against making a costly mistake.
So what does a proper due diligence process look like?
It involves a few key areas. First, you got to review those financial records, make sure everything adds up, verify the income and expenses, scrutinize those leases, and assess the financial health of the current tenants.
Like a financial background check for the property.
Exactly.
And then, of course, there are the physical inspections.
Crucial. You want those qualified professionals inspecting for structural issues, pests, environmental hazards, code violations, the works.
So it's a combination of expert analysis and using your own eyes and common sense.
Exactly. It's about getting a complete picture of the property's condition.
Okay, you've done your due diligence, found a property you love. Now it's time to negotiate.
The art of the deal.
The authors make it seem like a delicate dance.
It is. It's about finding that sweet spot where your offer is attractive to the seller, but you're also protecting your interests and ensuring a good return on your investment.
So it's a bit of a balancing act.
Definitely.
And the authors really emphasize understanding those contracts, making sure everything's clear and legally binding.
Contracts are your roadmap. They outline everybody's responsibilities, and they ensure a smooth journey to closing.
Got it. A roadmap to real estate success. Okay, we've talked about finding a property, due diligence, negotiating contracts, but there are two more things we got to discuss: tax strategies and exit planning.
Ah, yes, those crucial but often overlooked aspects. The authors provide a really great overview of those key tax considerations. Depreciation, passive versus active activity, capital gains exclusion, 1031 exchanges, opportunity zones.
Okay, so let's break those down, starting with depreciation.
Depreciation, sometimes called cost recovery, lets you deduct a portion of the property's value each year to reflect its wear and tear. It's not a cash expense, but it can seriously lower your taxable income.
So it's like a tax break just because your property is aging.
Pretty much. And the authors emphasize allocating a higher percentage of that purchase price to those depreciable assets like the building itself.
To maximize the deduction
Yeah,
rate.
exactly.
Now, what about passive versus active activities? What's the deal with that?
The IRS wants to know how involved you are in the day-to-day management of your properties.
So it's not just about, like, the hours I put in.
It's more about how the IRS classifies that involvement. If you're a passive investor, meaning you're not super hands-on, your ability to deduct losses is limited.
But if you're more active.
If you qualify as a real estate professional, you've got more flexibility.
Okay, so the IRS has got to categorize you. Got it. Now, on to capital gains. Those are the profits you make when you sell a property, right?
Yep. And the authors do a good job of explaining how those capital gains are taxed, highlighting the difference between those short-term gains, which apply to properties you've held for less than a year, and those long-term gains, which apply to properties held for longer than a year.
Ah, so that's another reason to play the long game.
Yeah, exactly. Holding on to those properties for a while could actually lead to lower tax rates on those profits.
Okay, so patience really is a virtue in real estate investing. Now, what about those 1031 exchanges we mentioned earlier?
1031 exchanges, a classic real estate strategy. It's a way to defer paying taxes on those capital gains when you sell a property. You do that by reinvesting those profits into another like-kind property.
So it's like rolling those profits into a new investment without having to pay taxes right away. That's pretty clever. But I'm guessing there are like some rules and regulations around this.
Oh, definitely. The authors point out those strict timelines and potential complications, so working with a savvy tax advisor is a must.
Good to know. And finally, what are those opportunity zones all about?
Opportunity zones are designated areas, often in communities that are, looking for a little economic revitalization.
So it's like a win-win. You get those tax benefits and the community gets an economic boost.
Exactly. It's a way to align your financial goals with those community development efforts.
Awesome. I love that. Well, we've covered a ton today, from the why of real estate investing to the what, the how, and even those tax implications. Real estate investing for dummies is packed with valuable info, that's for sure.
It's a great starting point for anyone looking to get into the game.
But this is just the beginning, right?
Oh yeah, just the tip of the iceberg.
This deep dive has given us a solid foundation, but now it's time to take all this knowledge and apply it to our own unique situations. So what specific type of real estate investment really speaks to you? And what's your next step in, making those dreams a reality?
That's a great question to ponder. And remember, real estate investing, it's a journey, not a destination.
Well said. A journey we're all on together.
Absolutely.
Stay tuned for more real estate insights.
Sounds good to me. As we were going through real estate investing for dummies, I noticed something that often gets overlooked.
Oh.
Understanding leases and how to actually value a property.
Yeah, I guess those are pretty, fundamental things.
They are, but it's easy to get caught up in the excitement of finding a property and kind of gloss over those details.
Right. It's like you're so focused on the hunt that you forget about the nitty-gritty.
Exactly.
So what did the authors say about leases?
Oh, they dedicate a whole chapter to them. And it makes sense. They're the backbone of any rental property. They set the terms of the agreement between you and your tenants.
So it's not just a piece of paper. It's the whole legal framework for that landlord-tenant relationship.
Exactly.
Okay, so leases are important. Now, what about valuing a property?
Property valuation. That's like assessing the health and potential of a business. You're not just looking at the balance sheet.
Yeah.
You're also considering its future prospects.
So how do you actually put a number on a property? What are the approaches?
Well, the authors walk us through the three main approaches. There's the market data approach, then there's the cost approach, and then there's the income capitalization approach.
Okay, let's break those down. First up, market data approach. That sounds like comparing apples to apples, looking at recent sales of similar properties to figure out what yours might be worth.
Exactly.
What about the cost approach?
The cost approach is more about figuring out what it would cost to build a replica of the property today.
Yeah.
You're factoring in land costs, construction materials, labor.
I see. So it's like, what would it take to rebuild it from scratch? Okay. And last but not least, the income capitalization approach.
Ah, yes, the income capitalization approach. This one focuses on the property's income-generating potential.
So like how much money it can bring in.
Exactly. You analyze the net operating income, or NOI, which is the income generated after you subtract those operating expenses.
So it's like the earning power of the property.
You got it.
Okay, so those are the three approaches: market data, cost, and income capitalization.
Got it. Now let's get into the financial nitty-gritty. How do we actually analyze those numbers and make sure a property is a good investment?
Well, the Dummies experts, they go deep on this. They provide all sorts of formulas and strategies for evaluating potential investments.
So we're not just eyeballing it and hoping for the best.
Definitely not. You got to crunch those numbers.
One key concept they highlight is the net operating income, or NOI, which we touched on earlier.
Ah, yes, NOI. A crucial measure of a property's financial performance.
Right, but it's often confused with cash flow.
Oh, yeah, that's a common mistake. So NOI, it's the income after deducting operating expenses, right? But before you factor in things like debt payments.
Exactly, and the authors are really, really clear about that distinction.
So NOI is like the raw earning power of the property, while cash flow is what you actually get to pocket after all the bills are paid.
You nailed it, and accurately projecting that cash flow is, like, essential for making smart investment decisions.
Makes sense. Now, the book also introduces some pretty advanced valuation techniques. Things like internal rate of return, or IRR, and net present value, or NPV. Those sound a little intimidating.
They can be, but they're really valuable tools for comparing different investment opportunities.
So what's IRR all about?
Think of IRR as the percentage return you'd earn on your investment,
Yeah.
over time. But it takes into account that whole time value of money concept.
Time value of money.
Yeah, it's the idea that $1 today is worth more than $1 tomorrow.
Because of inflation and all that.
Exactly.
So a higher IRR is generally a better sign.
Assuming the same level of risk, yes.
Okay, and what about NPV?
NPV, or net present value, helps you figure out the present value of those future cash flows.
So like bringing those future profits back to today's dollars.
Exactly.
Okay, so IRR and NPV, they're like those financial power tools that help you make smarter investment decisions.
You got it.
Now let's talk about negotiating.
The art of the deal.
Right. The Dummies Guide has some pretty solid advice on how to make those attractive offers, but also realistic ones.
Absolutely.
So what are some of their top tips?
Well, first and foremost, they emphasize research. You got to understand market values, and then be realistic about those potential repair costs and unexpected expenses.
Right, so don't get caught up in the excitement and overpay.
Exactly.
Well,
They also recommend making those offers in writing, clearly outlining all the terms, the contingencies, and even an expiration date.
so it's all nice and official.
Exactly.
And they also stress the importance of understanding contracts.
Oh yeah, contracts are crucial. They protect both the buyer and the seller.
So it's like having a clear roadmap for the whole transaction.
Exactly.
Okay, so we've talked about research, realistic offers, written offers, and contracts. Got it. But let's not forget about due diligence.
Due diligence is like the detective work of real estate investing.
Right. It's about uncovering those hidden clues, making sure everything is as it should be.
Exactly. The authors really drive this point home. Skipping due diligence is a recipe for disaster.
So what are the key areas to focus on during that due diligence process?
Well, you got to review those financial records, scrutinize those leases,
Yeah.
and you absolutely need those thorough physical inspections.
Okay, so for those financial records, we're looking for anything that seems fishy, right?
Exactly. Make sure the income and expenses check out, double check those leases, and make sure those tenants are, financially solid.
It's like a financial health checkup for the property.
You got it.
And those physical inspections, those are all about uncovering any hidden problems.
Exactly. The authors recommend hiring those qualified professionals, to inspect for structural issues, pests, environmental hazards, code violations, anything that could impact the property's value.
So it's like getting a professional second opinion.
Exactly. They can spot those things that you might miss.
Okay, due diligence, check. Now, what about the legal structure for holding the title? That seems like something important to consider.
Oh, absolutely. The way you hold title can have big legal and tax implications.
So what are our options?
Well, there's sole proprietorship, partnerships, LLCs, corporations. The Dummies Guide does a good job of outlining those.
So it's about choosing the structure that best fits your situation.
Exactly.
And probably something you want to discuss with, like, an attorney and a tax advisor.
Absolutely. They can guide you through the legal and tax maze.
Okay, legal structure, check.
Now, let's fast forward to that exciting moment. Closing the deal. What happens at closing?
Closing is the culmination of all that hard work, the moment you finally get those keys. Right, but there's still some paperwork to handle, right?
Oh, definitely. The authors walk us through those steps involved in closing escrow. Things like title insurance, property insurance, and those closing costs.
Title insurance, that always sounds so mysterious. What's that all about?
Title insurance, it's like an insurance policy for your property's history.
Yeah.
It protects you from those hidden defects or claims on the title that could pop up later.
So, like, surprises from the past.
Exactly.
And what about property insurance? That's pretty standard, right?
Absolutely. It's essential for any real estate owner. It protects you from all those what-if scenarios.
Like fires, theft, natural disasters, all those things.
Exactly. You definitely want to be covered.
And those dreaded closing costs, those can sometimes feel like a bit of a surprise expense.
They can. That's why the authors recommend getting a good faith estimate of those costs early in the process.
So you can budget accordingly and avoid any financial heart attacks. Okay, so you've closed on the property. You're officially a real estate investor. Now what? What about landlording?
Ah, landlording. That's a whole other adventure.
Right. It can feel like a full-time job on top of your regular job.
It can be, especially if you're managing multiple properties.
So what are some of the key things to know about being a landlord?
The authors cover it all. Finding and screening tenants, handling maintenance and repairs, dealing with those sometimes challenging tenant situations.
Okay, let's start with finding tenants. How do you attract those ideal renters?
Well, the authors talk about advertising effectively, targeting the right audience, setting clear rental criteria.
So it's not just about filling the space, it's about finding those quality tenants.
Exactly. You want tenants who pay on time, respect the property, and are, good neighbors.
Right. And how do you screen for those ideal tenants?
Thorough screening is key. Credit checks, background checks, verifying employment and rental history.
So you're doing your due diligence on those potential tenants too. Okay, you've got your tenants, they're all settled in. What about maintenance and repairs?
The authors recommend a proactive approach. Regular inspections, addressing any issues promptly.
So it's about being preventative.
Exactly. Preventative maintenance can save you a lot of headaches down the road.
And how about handling those tenant requests and repair?
Well, you got to have a system for managing those, make sure you're responding promptly, and that any repairs are done by, qualified professionals.
So organization and responsiveness are key. Now, what about those situations no landlord wants to deal with? Problem tenants.
Those are never fun. But the Dummies Guide acknowledges that it's part of being a landlord sometimes.
So what's the best way to handle those situations?
They emphasize documentation. You got to document everything, follow those legal procedures, and don't hesitate to seek professional help if needed.
So it's about understanding your rights as a landlord and handling the situation legally and ethically. Okay, so we've tackled finding tenants, maintenance, repairs, and even those tricky tenant situations. What about protecting our investment overall?
The Dummies experts are all about protection.
So what are their top recommendations?
Well, insurance, for starters. Both property insurance to cover those physical damages and liability insurance to protect you from, lawsuits.
So it's about having those safety nets in place.
Exactly. They also highlight regular maintenance, proactive property management, careful tenant screening. It's all about taking a holistic approach to protect your investment.
Makes sense. And they also remind us that the real estate market is constantly changing. Laws change, trends come and go.
Yep. You got to stay informed.
So it's a constant learning process.
It is.
Okay, now let's talk about record keeping and accounting. I know it might not be the most glamorous part of real estate investing, but it's got to be important.
It's crucial. The Dummies Guide dedicates a whole chapter to it.
So what are the key things to keep in mind when it comes to record keeping and accounting?
Organization. They recommend setting up a system for tracking all your income and expenses, organizing those receipts, and generating those financial reports.
So no more shoeboxes full of crumpled receipts.
Hopefully not.
And they also emphasize separating personal and business finances, having dedicated bank accounts for each property, using a consistent system.
Yep, all those good habits.
And as your portfolio grows, they suggest switching to a computerized accounting system.
Absolutely. It just makes things so much easier.
Okay, so record keeping and accounting. Check. Now, on to the topic everyone loves, taxes.
Everyone's favorite subject.
Right. But the good news is the Dummies guide breaks down those tax considerations in a way that's surprisingly understandable.
They do a great job of making those complex concepts a little less intimidating.
So let's revisit those key tax considerations. First up, depreciation.
Depreciation, that wonderful tax break. It lets you deduct a portion of the property's value each year to account for wear and tear.
So it's like getting rewarded for your property getting older.
Pretty much.
And what about that distinction between passive and active activities?
Yes, that's back again. It all boils down to how involved you are in the day-to-day management of those properties.
Right, and that determines how you can deduct losses.
Exactly.
And the authors lay out those criteria for qualifying as a real estate professional, which can be beneficial for those who are, really hands-on with their properties.
Absolutely.
Now, capital gains, how are those taxed?
Well, the authors explain that it depends on how long you've held the property. There's a difference between short-term and long-term capital gains.
And holding those properties for the long haul often results in lower tax rates.
Exactly.
So patience pays off, literally.
It does.
The authors also mention the capital gains exclusion for homeowners. What's that all about?
That's a fantastic benefit.
Yeah.
It lets you potentially exclude up to $500,000 in profit from the sale of your primary residence.
Wow, that's a pretty sweet deal. Okay, and then there are those 1031 exchanges, which can be used to defer paying taxes on those capital gains.
Right. It's a powerful tool for those who are actively building their real estate portfolios.
So 1031 exchanges, they're like a way to keep those profits rolling into new investments without having to pay taxes right away.
Exactly.
Okay, taxes. Check. Now, the Dummies Guide wraps up with a chapter on increasing a property's value and maximizing those returns. What are some of their top strategies?
Well, one obvious way to boost incomes to, raise those rents. But the authors caution against being too aggressive with those increases.
Right, you don't want to scare away those good tenants.
Okay.
So how do you know how much to raise the rent?
They suggest doing your homework, understanding comparable rents in your area, considering factors like amenities, location, and tenant demand.
So it's like finding that sweet spot where you're maximizing income without pricing yourself out of the market.
Exactly. And they also stress communicating those rent increases effectively.
Right. Give those tenants plenty of notice and explain why the rent's going up.
Exactly.
Okay, what about reducing turnover?
Tenant retention. That's crucial for keeping those units filled and the cash flowing.
All right. It's much easier than constantly having to find new tenants.
Exactly. The authors emphasize the importance of attracting and keeping those good tenants, by offering well-maintained properties, being responsive, and fostering those positive landlord-tenant relationships.
So it's all about keeping those tenants happy.
Happy tenants, happy landlord.
I like that. Now, beyond raising rents and reducing turnover, what are some other ways to boost a property's value?
The authors recommend considering lease options, which can provide a steady stream of income, and they might even lead to a sale down the line.
Oh, yeah, we talked about those earlier.
They also talk about finding a niche, catering to a specific type of tenant or offering those unique amenities that make your property stand out.
So it's about giving those tenants a reason to choose your property over all the others.
Exactly.
Okay, so lease options and finding a niche. What else?
Ongoing maintenance and renovation. It's important to keep those properties in tip-top shape.
Right, so you're not just setting it and forgetting it.
Definitely not. It's about continuously investing in your property.
Makes sense. And on the financial side, they suggest keeping an eye on those property tax assessments.
Yep. And exploring refinancing options to potentially lower those monthly payments or even tap into some of that equity for other investments.
So it's all about being financially savvy.
Exactly.
Now, one piece of advice that really stuck with me, knowing when to let go.
Yes, sometimes selling is the smartest move.
Right. If a property's not performing or it's just not aligned with your goals anymore, it might be time to move on.
Exactly.
Okay, so we've covered a ton of strategies for increasing value. Now, the Dummies Guide distills all their wisdom into 10 actionable steps for real estate. investing success.
It's like a roadmap to real estate riches.
All right, let's walk through those steps. Step 1, building savings and cleaning up your credit.
Ah, the foundation.
All right, they really emphasize that financial preparedness is key.
Absolutely. You want to have a solid base before you even think about jumping into the real estate market.
So pay down that high interest debt, build up those savings, make sure that credit score is sparkling.
Exactly.
Okay, step 2, buying in the path of progress.
Ah, yes. Finding those up-and-coming areas.
Right. It's about identifying those neighborhoods with growth potential.
Exactly. They encourage looking beyond those obvious hot spots
Yeah.
and considering those areas that are, on the verge of a transformation.
So you're not just buying a property, you're investing in a neighborhood's future.
Exactly.
Okay, step 3, buying the right property at the best price possible.
Ah, the art of the deal.
Right. They stress the importance of research, market analysis, and those negotiation skills.
Absolutely.
So it's about finding that balance between being aggressive and being realistic.
Exactly.
Step 4, renovating property the right way.
Ah, renovations. They can make or break an investment.
So what's the right way to approach renovations?
Well, the authors caution against over-improving a property. It's all about making those strategic upgrades that will appeal to your target market.
So you're not creating your dream home. You're creating a property that renters or buyers will love.
Exactly.
Step 5, keeping abreast of market rents.
Ah, yes, staying informed.
Right. The real estate market is always changing, so you got to keep your finger on the pulse.
Absolutely. Knowing what's happening in your area is crucial.
So how do you stay informed?
Check those online rental listing sites, talk to property managers,
Yeah.
connect with other landlords.
Network.
Exactly.
Okay. Step 6, recovering renovation dollars through refinancing.
Ah, yes. Using your property's increased value to your advantage.
Right. So it's like turning your property's success into fuel for even more investments.
Exactly. Refinancing can help you access that equity, and you can use it for more renovations, buying additional properties, or even diversifying your portfolio.
So it's like a snowball effect. Your investments keep building on each other.
Exactly.
Okay, step 7, repositioning property with better tenants.
Ah, yes, the importance of quality tenants.
Right. It's about finding those tenants who pay on time, respect the property, and contribute to a positive rental community.
Exactly.
Step 8, becoming or hiring a superior property manager.
Delegating those responsibilities can be a game changer.
Right. It can free up your time, reduce stress, and potentially boost your return.
Absolutely. But finding the right property manager is key.
So what should you look for in a property manager?
Experience, a good track record, strong communication skills, someone who understands your investment goals.
So it's like a partnership.
Exactly.
Okay, step 9, refinance or sell and defer again.
Ah, yes, using those financial tools strategically.
Right. The authors remind us about refinancing to secure a lower interest rate, shorten that loan term, or even access more equity. And then there are those tax-deferred exchanges like the 1031 exchange.
Right. Those can help you keep those profits working for you and avoid those capital gains taxes.
So it's all about minimizing those tax burdens and maximizing those returns.
Exactly.
And finally, step 10, consolidating holdings into larger properties.
Thinking big.
Right.
Right.
So as your portfolio grows, it might be time to level up.
Exactly. The authors point out that those larger properties can offer some advantages. Things like economies of scale, which means your operating costs per unit might be lower. Plus, they provide some diversification benefits.
So you're spreading your risk across a larger pool of tenants.
Exactly.
Okay, so those are the 10 steps to real estate investing success. A lot to digest.
It is, but it's a great roadmap for anyone looking to build a successful real estate portfolio.
Wow, I'm feeling like a real estate whiz now.
Me too.
You know, going through real estate investing for dummies, one thing that really hit me is that it's not just about numbers, you know?
Oh, I totally agree.
It's also about, like, psychology.
Psychology.
Yeah, like understanding market trends, anticipating future growth, making those decisions based on, like, gut feeling as well as logic.
Ah, I see what you mean. It's like having that sixth sense for a good deal.
Exactly. And that takes a certain level of, like, psychological awareness.
Yeah, you gotta be able to manage those emotions, assess risk, make tough calls under pressure.
So it's like being part detective, part psychologist, part financial analyst.
That's a great way to put it.
Okay, so as we wrap up this deep dive, I'm curious, What were some of your biggest aha moments? What really stuck with you?
Well, for me, it was that emphasis on thinking long term.
Right.
They really hammer home that real estate investing, it's not a get-rich-quick scheme.
It's a marathon, not a sprint.
Exactly.
What else?
That whole due diligence thing, they really drove that point home.
Right. Skipping due diligence is like playing real estate roulette.
It's asking for trouble.
And what about assembling that team of trusted professionals?
Oh, that's crucial.
Right. Having those experts in your corner can make all the difference.
Absolutely.
So, as we close out this awesome deep dive, what advice would you give to someone who's just starting out in real estate investing?
Good question. I'd say first and foremost, educate yourself. Soak up as much knowledge as you can.
Right. Knowledge is power.
Exactly.
Ugh.
And don't be afraid to ask questions, find mentors, learn from the pros.
Okay. Solid advice. What else?
Start small.
Yeah. Don't bite off more than you can chew.
Exactly. Maybe try house hacking, explore partnerships, even dip your toes into REITs.
So, it's about taking those baby steps and gaining experience along the way.
Exactly.
Awesome. Well, I think we've covered just about everything there is to know about real estate investing.
I think we did a pretty good job.
Thanks for joining us on this epic deep dive into real estate investing for dummies.
It's been a pleasure.
Remember, real estate investing, it's a journey. And every journey starts with that first step. So get out there, explore, learn, and start building your real estate empire.
Onwards and upwards.
Until next time, happy investing.